Hi everyone, and welcome back to the channel. With the click of a button these days, we have access to a wealth of investment information, but there's also just as much conflicting information out there about which trends and stock indicators we should be focusing on. So today we're going to take a look at stock prices and why a stock that is priced lower than its competitor doesn't necessarily mean that it's a better buy. So let's start things off with share price. Share price is the first and last place that most investors look when evaluating a company. It's the one used in industry reports, talked about in the media, and likely has the biggest impact on the value of your investment account. Stock price alone, though, tells you very little about a company itself. The price of a stock represents what the last two individual buyers and sellers agreed was a fair price for that stock. The next group of individuals, though, or potentially even computers, may think that that stock is worth far more or far less. Share price is supposed to be an indication of the long-term value of a company. As the future of the company improves, whether it's through news reports or market sentiment, the price goes up. If bad news comes out, though, or the economy changes, the price may fall. So looking at two rival companies with equally opportunistic futures, if one has a cheaper stock price, then that has to be a better value, right? Well, not necessarily. Let's talk a bit about market cap. Market cap, or market capitalization, represents the total value of a company's outstanding shares. We take all of the shares that are out there available to investors, multiply that by the current price, and that's what the company's market cap is. As the stock price goes up and down, then the market cap will go up and down as well. So why is it so important to look at market cap when we're analyzing share price? Let's compare two fictional companies. Company A is currently trading at $20 and Company B at $10. Looking at stock price alone, you might unknowingly be comparing a small business to a very large one. Just because Company A is priced higher doesn't mean it's more successful. And just because Company B is priced lower but is a much larger company doesn't mean that there's more value there either. On top of that, you also need to be aware of stock splits and consolidations that will increase or decrease the number of shares outstanding. As a current owner, it will have no effect on the value of your investment, but as a potential buyer, it can pose additional risk to those basing their decisions on price alone. Let's say, for example, that you're looking at purchasing either of the below two companies. One is priced at $4 and the other at $25. Now you're thinking to yourself, they both have the same opportunities, they're both in the same market, but the $4 stock is a better buy because I already know it has the opportunity to hit $25 like Company B did. So I'll likely have a better chance of making more money by investing in Company A. What you didn't know is that Company A has gone through multiple stock splits and now has 1 million shares outstanding, compared to Company B that only has 160,000. In order to hit $25 a share, that would mean that Company A would need to increase their market value to $25 million, more than 6 times the size it is today and significantly larger than Company B at the exact same share price. If you look at stock price alone, you're not seeing the total picture. As another example, Manulife and Canadian Western Bank are two very different financial companies. Yet looking at just stock price, that might lead you to believe that Canadian Western is a much more successful company than Manulife. There are some risks to focusing just on market cap alone as well, though. You've probably heard terms like small cap, mid cap, but those descriptions are not the same in every market. A large cap company in Canada may only qualify as a smaller mid cap company in the United States, but market cap can provide a few helpful insights. A large cap company will tend to be a large, well-established firm with revenues both domestically and also abroad, or have multiple streams of income. A good example of those might be one of the major Canadian banks or telecom companies, for example, like Rogers or Bell. Another well-known large cap company that you've likely heard of is Shopify. A mid-cap company, though, will be smaller in size, may be domestically focused, but still really well known. So you've probably heard of Dollarama or Canadian Tire, both well-established companies in Canada with just under a $2 billion market cap. These are well known to us, but they're not well known outside of Canada. A small cap company may be a regional company or have a specific niche. Sleep Country Canada is an excellent example of a well-known firm that, by virtue of their business, may likely always remain a small cap company. But you shouldn't discount the investment opportunity of small cap companies. At this size, you may find that companies are more likely a takeover target by larger firms. Investments at each cap level have their own merits, but it is important to understand the type of firm that you're potentially investing in. Thank you so much for watching, and we'll see you next time.